I want to begin by setting a clear frame for this conversation because framing determines understanding. This is not a discussion about quick wins, sudden price moves, or short-term excitement. This is a conversation about systems, about how global finance actually shifts, and about how wealth is quietly positioned long before it becomes visible. If you are someone who prefers understanding over emotion, structure over noise, and long-term thinking over instant reaction, then you are exactly in the right place. Something meaningful has just happened in the global financial system. It did not come with fireworks. It did not dominate social media feeds. It did not trend on chart-watching platforms for very long. But structurally, it matters. Japan has ended nearly 30 years of zero interest rate policy. That sentence alone may sound technical, even boring to many people. Yet beneath it sits one of the most important shifts in modern monetary history. And understanding why this matters is not about predicting tomorrow's price action. It is about recognizing how the plumbing of global finance is changing and why certain digital assets, including XRP, sit closer to that plumbing than most people realize. Most people miss this development because they were watching charts. They were watching candles move up and down, waiting for confirmation, signals, or momentum. But real financial change does not start on charts. Charts are reflections. They are outcomes. The real changes happen underneath, in policy decisions, in settlement systems, in liquidity flows, and in the incentives that guide institutions. Today, we are going to focus on that underlying layer, calmly and clearly, without hype or urgency. When we talk about macro policy changes, it is important to understand that they always matter before price ever reacts. This is one of the most misunderstood ideas in markets, especially in digital assets like XRP. Most people are trained, almost conditioned, to believe that price movement is the signal. In reality, price is the echo. It is the last thing to respond, not the first. Macro policy decisions, such as changes in interest rates, liquidity conditions, or regulatory posture, alter the incentives that guide capital. These decisions do not exist to move markets in the short term. They exist to stabilize systems, manage risk, and guide long-term economic behavior. Because of that, their impact begins quietly, inside balance sheets, settlement processes, funding strategies, and institutional planning cycles. None of this shows up immediately on a price chart. This is why so many people miss important transitions. They are watching candles, indicators, and momentum, while the real shift is happening underneath the surface. Institutions do not react emotionally to headlines. They respond structurally to changes in cost, efficiency, and risk. When a macro policy environment changes, institutions reassess how capital flows, how liquidity is managed, and which systems reduce friction over time. That reassessment can take months or years, but it starts long before price responds. In the context of XRP, this distinction matters. XRP is often discussed through the lens of speculation, legal outcomes, or short-term sentiment, but its original design sits closer to infrastructure than to narrative. It is built around settlement efficiency, liquidity movement, and cross-border functionality. These qualities do not become immediately valuable because people are excited. They become valuable when the system itself begins to feel pressure. Macro changes create that pressure. When capital has a cost, inefficiencies become visible. When settlement delays tie up liquidity, those delays are no longer ignored. When systems designed for a different monetary era begin to strain, institutions look for tools that reduce friction rather than amplify risk. This process happens internally, quietly, and without public validation. Price, meanwhile, remains disconnected for a long time. This disconnect confuses retail participants who expect immediate feedback. When price does not move, they assume nothing is happening. In reality, positioning is forming. Infrastructure is being tested. Relevance is being evaluated. By the time price eventually reflects these changes, the underlying decisions have already been made. This is why patience is not a personality trait in investing. It is a structural advantage. Those who understand systems can remain calm during periods of apparent inactivity. They do not need constant confirmation. They recognize that meaningful shifts do not announce themselves loudly. Clarity comes from understanding sequence. Policy changes first. Incentives shift next. Infrastructure adapts after that. Price reacts last. Reversing this order leads to confusion, frustration, and emotional decision-making. For long-term thinkers, the goal is not to predict when price will respond, but to understand whether alignment exists between macro direction and system design. When that alignment is present, time becomes an ally rather than an enemy. In the end, the calm investor is not the one who reacts fastest, but the one who understands deepest. By focusing on structure instead of noise and systems instead of sentiment, patience becomes natural, clarity becomes stable, and long-term perspective replaces urgency. When money is no longer free, capital efficiency stops being a theoretical concept and becomes a daily operational concern. For a long period in modern financial history, extremely low or zero interest rates allowed inefficiencies to exist without consequence. Capital could sit idle, settlement could take days, and liquidity could be spread across multiple locations without creating visible stress. The system learned to tolerate friction because the cost of time was minimal. That environment quietly shaped behavior. Institutions adapted their processes around the assumption that funding would remain cheap and abundant. Risk models, settlement cycles, and liquidity management strategies were built for a world where delay had little penalty. This was not reckless behavior, it was rational behavior under the conditions that existed at the time. When those conditions change, even gradually, the logic of the system changes with them. As interest rates normalize and capital regains a cost, inefficiency becomes measurable. Every unit of capital tied up in slow settlement, redundant accounts, or unnecessary intermediaries now carries an opportunity cost. What once felt acceptable begins to feel heavy. What once felt invisible becomes visible. This shift does not trigger panic. It triggers reassessment. Institutions begin asking different questions. How much capital is locked in transit? How long does settlement truly need to take? How many layers exist simply because they always have? These are not emotional questions. They are balance sheet questions. And balance sheet questions drive long-term change far more reliably than market sentiment. This is where investor psychology often diverges from institutional reality. Many investors look for signals in price movement or public announcements. Institutions, by contrast, respond to cost structures and efficiency metrics. They explore tools and systems that reduce friction not because they are new, but because they align with the new economic environment. In the case of XRP, its relevance, if it develops, would emerge from this exact pressure point. Its design focuses on moving value efficiently, reducing settlement time, and minimizing the need for pre-funded liquidity. These characteristics are not exciting on their own. They become meaningful only when the system begins to feel the weight of inefficiency. Importantly, this process unfolds quietly. There is no requirement for broad belief or public enthusiasm. Infrastructure changes are rarely celebrated when they are implemented. They are noticed later, when outcomes improve and old methods feel outdated in comparison. This is why long periods of apparent inactivity often precede recognition. For investors, this creates psychological discomfort. Human nature seeks feedback. When nothing seems to be happening, doubt increases. But the absence of visible change does not mean the absence of progress. It often means progress is occurring at a level that is not designed for public observation. Understanding this dynamic helps separate emotion from analysis. Instead of asking when something will happen, a calmer and more productive question is whether conditions are becoming more favorable for a certain type of solution. When money is no longer free, solutions that improve efficiency naturally gain attention, regardless of narratives. In the long run, patience is not passive. It is informed restraint. Clarity comes from understanding why systems change, not from reacting to when they appear to change. By focusing on efficiency, incentives, and structure, long-term thinkers remain steady while others search for constant reassurance. And in that steadiness, perspective replaces urgency, allowing time to work without emotional interference. Infrastructure, adoption, rarely looks the way most people expect it to look. Papu. LAR narratives suggest that when a new system is important, it will arrive loudly, with clear signals, widespread attention, and immediate validation. In reality, the opposite is usually true. The most consequential infrastructure changes tend to happen quietly, gradually, and without public celebration. They emerge not from excitement, but from necessity. Institutions do not adopt systems because they are interesting or fashionable. They adopt systems because those systems reduce cost, lower risk, or solve a problem that existing tools no longer handle efficiently. This process begins long before the public becomes aware of it. Internal evaluations, pilot programs, limited integrations, and risk assessments are the real first steps. None of these stages produce headlines, and none of them move markets in obvious ways. This disconnect creates confusion for observers who rely on visible signals. Many investors expect confirmation through price movement or public endorsement. When neither appears, they assume progress is not occurring. What they miss is that infrastructure is not built for visibility. It is built for reliability. When it works, it is meant to disappear into the background. In the context of XRP, this distinction is especially important. XRP is often discussed as if its relevance depends on public excitement or collective belief. But infrastructure does not operate on belief. It operates on functionality and alignment with system needs. If a settlement mechanism reduces friction, improves speed, or frees capital, it becomes useful regardless of whether it is popular. Adoption at this level is cautious by design. Financial institutions carry responsibility for stability, compliance, and trust. They test systems in controlled environments, often for extended periods. Progress may appear slow, but this caution is a feature, not a flaw. It ensures that when adoption does expand, it does so on a stable foundation. Investor psychology often struggles with this reality. Human attention is drawn to movement, novelty, and affirmation. Quiet progress feels unsatisfying because it does not reward attention in the short term. This can lead to impatience or misinterpretation. Silence is mistaken for failure. Delay is mistaken for rejection. A more mature perspective recognizes that silence can also mean evaluation, preparation, or integration. Many systems that are now considered essential were once ignored precisely because they did not demand attention. They solved problems quietly until the old methods could no longer compete. Understanding this pattern allows long-term thinkers to remain calm during periods of low visibility. It shifts focus away from external validation and toward internal alignment. The question becomes not whether something is being talked about, but whether it fits the direction in which systems are evolving. This approach does not require optimism or pessimism. It requires patience and clarity. It acknowledges uncertainty without reacting to it emotionally. It respects the pace at which serious institutions operate and the nature of infrastructure itself. In the end, meaningful adoption is rarely announced. It is discovered in hindsight. Those who understand this do not feel rushed by silence or unsettled by inactivity. They remain steady, grounded in process rather than noise. By valuing structure over spectacle and function over attention, they develop a long-term perspective that replaces urgency with understanding and allows patience to become a strength rather than a struggle. Long-term positioning is often misunderstood because it does not feel productive in the way short-term action does. Many people equate movement with progress and stillness with stagnation. In financial systems, the opposite is frequently true. The most effective positioning often happens during periods that appear quiet, uneventful, or even frustrating. These are the moments when understanding matters more than action. Markets are designed to test emotional endurance. They reward activity with stimulation and punish patience with uncertainty. This creates a psychological environment where investors feel pressure to react, adjust, or constantly reassess. Yet systems do not change at the pace of emotion. They evolve through planning cycles, regulatory processes, infrastructure development, and gradual shifts in incentives. Long-term positioning aligns with these slower rhythms rather than fighting them. In the context of XRP, this distinction is important because the asset is often evaluated through short-term lenses that do not match its original purpose. When progress is measured only by visible outcomes, such as headlines or market response, periods of silence feel uncomfortable. This discomfort can lead to doubt, overinterpretation, or the temptation to force conclusions before enough information exists. A more grounded approach focuses on whether an asset or system remains aligned with long-term structural trends. This does not require certainty. It requires coherence. If the direction of global finance emphasizes efficiency, liquidity optimization, and cross-border functionality, then systems designed around those needs remain relevant regardless of timing. Timing is unpredictable. Alignment is not. Investor psychology plays a central role here. Humans seek closure. We prefer clear outcomes and quick feedback. Long-term positioning denies that comfort. It asks for tolerance of ambiguity and acceptance of incomplete information. This is not easy, but it is necessary when dealing with complex systems that involve regulation, institutions, and global coordination. Clarity, thank you, comes from separating what can be controlled from what cannot. No one can control when systems adopt new tools or when markets recognize value. What can be controlled is understanding. Understanding reduces emotional noise. It allows investors to observe developments without internal pressure to act prematurely. This mindset also protects against extremes. Without clarity, long-term positioning can turn into blind belief or stubborn attachment. With clarity, it remains flexible and analytical. It allows for reassessment without panic and patience without denial. It is not about waiting endlessly. It is about waiting intelligently. The quiet periods are not empty, they are informational. They reveal how systems behave without attention and how narratives evolve without reinforcement. For those willing to observe calmly, these periods provide insight that cannot be found during moments of excitement. In the end, long-term positioning is not about predicting outcomes. It is about preparing for possibilities while staying emotionally balanced. By focusing on structure rather than noise and alignment rather than immediacy, investors develop a steadiness that does not depend on constant confirmation. This steadiness creates space for clear thinking, disciplined patience, and a perspective that respects time as a necessary component of meaningful change.